All the dividend aristocrats have grown their dividends for at least 25 consecutive years, but that criteria for cash flow growth hides the fact that some of these 67 stocks in the dividend aristocrats list grow their dividends like turtles hump, extremely slowly. And by the way, you're welcome for that image that you will not be able to get out of your head now. Anyway, for example, Cardinal Health, with its 38 years of increasing dividends, has only grown the payout by 1% a year over the last 3. In fact, that is a dividend cut if you count for inflation. And while the 3.7% annual dividend growth on West Pharmaceuticals is better, that 0.19% yield doesn't even qualify as a dividend stock in my book. So I wanted to highlight the true dividend aristocrats, those 7 aristocrats with the fastest dividend growth and the yields that will put cash in your pocket. We'll count up to a stock increasing its dividend by 17% a year, but let's start out with Leggett & Platt, ticker LEG, with its 6.9% dividend yield. Leggett is a global leader in manufactured components for home and auto, including bedding, furniture, flooring, and industrial parts. More than 60% of sales are from the home segment, with nearly half of that from bedding. The company does have some diversification though, with 35% of its sales outside the United States and 40% in the auto and industrial segment. With the housing market correction and the slump in auto sales, earnings for the company have been hit hard. Profits are expected to fall 30% to $1.53 per share this year on a 5.7% drop in revenue. That's going to mean the company is going to have to put on debt to keep up with that $1.84 per share dividend, plus however much it grows to keep up that 50-plus year tradition. And that would normally worry me about a dividend cut, but the company has $316 million in cash, and earnings are expected to bounce back next year. The board gave us a signal of its confidence with a dividend increase just last June, and the valuation is very attractive here. Leggett has grown its dividend by an annualized 4.7% over the last 3 years, and while that could slow a little over the next few, it's still a solid grower. Shares are trading at just 0.78 times revenue, a discount of 13% from the longer-term average. If the business does improve over the next year, the stock price will reward investors along with that dividend, but the risk is going to be higher on this one compared to others on the list. And next year, you usually don't see a 58% crash in these consistent dividend payers, but Stanley Black & Decker, ticker SWK, has faced a perfect storm over the last 2 years. First, supply chain issues persisted longer than expected and inventory built up. That hit profitability, driving up those costs and forcing discounting to move the product. Then more inflation and housing market weakness cut into those sales and halved the earnings per share. But this is a solid company with a number 1 or number 2 market position in nearly every category of its tools and outdoor products. In fact, the company has been paying a dividend for more than 146 years. Management unveiled a $2 billion cost savings program that runs through 2025 that should bring it back into stronger profitability. The payout ratio is at 70%, which would worry me here, but earnings are expected higher by 15% next year, which is going to take a lot of that investor worry out of the stock. Even against this negative backdrop, though, the company has been able to keep up that 4.9% annual growth in its dividend payments, raising the dividends just last month and paying a 3.7% yield. Right now, the stock trades for 0.8 times on that price-to-sales basis, about half the 5-year average valuation. I think this one gets up to 1 or 1.2 times over the next couple of years, translating to a 40% price return on top of the dividend. We're just getting started, but first I'm relaunching our custom portfolio tracker with a 33% discount, only with the link in the description below. This is so much more than just a stock portfolio tracker where you put in your stocks and how much you paid. It's going to tell you the sector, the industry, and the return on each stock. It's even going to show you how much of your portfolio you have in each stock. You can put in 2 stocks to compare them side by side as well against the sector averages in 10 critical measures for stock analysis. The spreadsheet downloads all this data directly from the internet, so you get up-to-date information. Here in this Investing Goals tab, you put in your age, years until you want to retire, and how much you invest each month. The spreadsheet is going to use your current portfolio, past returns, and how you invest to estimate exactly how much you'll have when retirement comes. It will also help you find how much you'll need to live well. This is a complete stock portfolio and financial goals spreadsheet, and again, I'm relaunching it with a 33% discount. You're going to get lifetime access to any updates, videos on how to use it, and how to reach your goals. I'll leave a link in the description below to that special relaunch discount, so check that out. Next up on our Aristocrats list is one of the most consistent performers, Chevron Corporation, ticker CVX, with its 3.6% yield. While Devon Energy and Diamondback produced higher returns for my portfolio over the last few years, no other energy company combines the return and safety like Chevron. Low cost of production and great management across a huge mix of energy sources gives Chevron the diversification to survive any environment. That means the shares don't fall apart when oil prices drop. In fact, at over 6% annualized, Chevron has one of the highest dividend growth rates among energy companies over the last 5 years. That, combined with the share buyback program, means cash and price return for investors. Dividend growth has slowed marginally to 5.3% annually over the last 3 years, but the recent pop in oil prices will support even faster growth. The company is investing heavily to offset the future decline in oil demand, growing its renewable hydrogen and carbon capture assets. That could help protect the dividend far longer than other traditional oil companies. Chevron is also prioritizing cash return and usually increases the dividend for the November payment. It's also recently raised the buyback program to as high as $20 billion, taking as much as 6% of the shares off the market. Shares are trading for an attractive 12 times PE ratio and a solid dividend yield. Medtronic, ticker MDT, is the largest medical devices company by revenue with $32 billion in annual sales and producing a 3.3% dividend yield. The equipment leader books half of its revenue from established devices, providing that cash flow necessary to reinvest into high-growth next-generation devices while still supporting investor cash return. The company reported growth in 4 of its 5 revenue segments in the first quarter, with organic growth as high as 6.3%. In fact, the only segment not seeing growth was this other group, which is like special projects and not usually a growth engine anyway. More importantly, earnings grew at a 13% annual pace, and management raised its guidance to 4.5% revenue growth this year and earnings as high as $5.16 a share. That means the payout ratio of 53% leaves plenty of room for growth while still protecting cash flow to reinvest into R&D. The dividend was just increased in June and has grown at a 5.9% pace over the last few years. We're getting into the big time next with a stock that's grown its dividend by almost 7.8% a year, but I'm not about just dropping a list of stocks in your lap. Nation, I want you to understand how I found these and how to do your own research to pick better investments. Of course, we already know the criteria to be in the Dividend Aristocrats list, that 25 years plus of increasing payments. That makes a stock part of the Dividend Champions, a list of over 100 stocks, but then those that are also a part of the S&P 500 index, those are the Dividend Aristocrats. That S&P 500 list is the largest 500 companies based in the US, so that narrows the aristocrats to only those largest dividend payers with that growth. But as I pointed out, some of those aristocrats pay yields so low that it's hard to think of them as dividend stocks, and the growth in dividend for some has been unimpressive at best. So for my list, I first narrowed down to only those dividend aristocrats with a yield of at least 3% or higher. That filtered out more than half the 67 stocks on the list. I then ranked the remaining stocks by dividend growth, going to the historical tab on Yahoo, switching this period to the last 3 years, and then to show only dividends. With that and a quick calculation, I was able to find the annual dividend growth for each dividend aristocrat. From there, I analyzed each stock for dividend sustainability and upside potential on the price to narrow down our list to these 7 best stocks. Let's get back to our list, but I want to get your input on this as well. How do you look for dividend stocks? What criteria do you use? So scroll down, let me know in the comments what's most important for you when looking for your dividend stocks to buy. Shares of Abbvie, ticker ABBV, have been in a tough spot for the last year, but still pay an attractive 3.8% dividend that's increasing faster than most. Abbvie is a best-in-class immunology drug company with a solid pipeline in oncology and eye care as well. The company has been able to grow that dividend by 8% a year over the last 3 and books a 43% payout ratio. But before you get too excited here, there is a warning on why I'm a little hesitant on the stock right now. The big worry for Abbvie right now is its patent expiration on blockbuster drug Humira. Management is forecasting an 8% drop in sales this year and its 3rd straight year of lower revenue next year on competition from those biosimilar drugs from other companies. It's going to be difficult keeping up that sales growth from these new drugs, but that's just the name of the game in pharmaceuticals. Abbvie does have a best-in-class pipeline with more than 20 indications in phase 3 or submitted applications alone. Sales for Scoritsu were up 80% on a year-over-year basis last quarter, and Rinvoq was up over 50%. And none of this is going to keep the company from staying on that Champions and the Dividend Aristocrats list, increasing its payment. Here we see that strong 7.8% annual increase, with the payout usually increased in January. Even if that growth slows to 5% over the next few years, it's still a good yield and solid growth. We're into the triple-digit dividend growers with T. Rowe Price, ticker TROW, and its 4.4% dividend yield. TROW holds over $1.4 trillion in assets under management through its ETFs, mutual funds, and advisory practice. Founded in 1937, it's increased the dividend for 38 consecutive years. The last 3 years saw a trifecta of shareholder cash return, with $700 million in special dividends, a $2.2 billion share repurchase program, and nearly $3.1 billion in regular dividends. And you see that special dividend of $3 here in the history, and a strong 10.5% annual growth in the regular dividend alone. Our last stock, though, has increased its dividend for 52 straight years, making it not just an aristocrat, but a dividend king. Check out the video here for a full list of the dividend kings, or check the description below for videos on the dividend champions and the dividend kings. But that highest dividend growth really surprised me. Target, ticker TGT, with its 3.6% dividend yield. Because you wouldn't expect a mature retail business to grow its dividend at a 17% annual pace or increase the dividend for 52 straight years. That is what makes Target a dividend king. Target is struggling under the same weakening consumer and increase in theft that all retail has seen, but a 60% payout ratio means the dividend is safe and the company is going to continue to grow that payout. Strong improvement in its operating margin over the third quarter helped to lift earnings, and in-stock levels are being better managed right now. I pointed out in another video, a recent survey found that millennials favored Target over Walmart, which could help the retailer take some of that market share over the next decades and support that cash flow return. Take advantage of that special relaunch discount and get 33% off our custom portfolio tracker spreadsheet, or click on the video to the right for the Dividend Kings, stocks with more than 50 years of higher payouts. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.